Hi, good morning all. It's Barry. I'm the founder here and CEO at Myriad. I am going to present to you today. It's all about this wonderful subject called SPVs to accelerate your video games expenditure credit. Now, before I kick off, anybody have questions? We do have a little icon at the top. You see Q&A, so please put your question in there and we will answer that towards the end. I will be joined by my colleague Chris, who can answer some questions alongside myself. He is really one of our key BFI experts at Myriad, and he's a huge gamer, spends far too many hours at the weekend, so his wife tells me. And then Karen joined in as well. But yeah, so this is all about SPVs and video games expenditure credit. We did do a fundamentals webinar, which is on YouTube. So feel free to search for our YouTube channel at Myriad. And I said, that's a great introduction, but this is going to go in a bit more deeper, and it's specifically regarding special purpose vehicles. So today's agenda, we are going to cover very quickly the VGEC rates. Why does VGEC get delayed? The SPV basics and benefits, the special purpose vehicle structures, the compliance conditions, the tax efficiency benefits. As I say, it's all about SPVs, the legal agreements, the key legal agreements and records that are required, typical SPV structures, funds flow example, and how we can help for the whole process from start to finish. And we will be answering your questions live. Now, as I said, special purpose vehicle is something which this is all about. So you can see the agenda is related to various elements of that. So quickly going to cover off how much is VGEC worth. Now VGEC, as you know, you can claim the 80% of the total core costs and the lower or the actual eligible core costs take into account. They've got to be UK based core costs. The gross rate's 34%. You have to deduct corporation tax because you've got to treat that as being income, gross income received into your organisation, and that therefore gets applied at the corporation tax rate of 25%. So the real world benefit of VGEC is 20.4% of the eligible core costs. Okay, now the quick example there, you'll see that in this case we've got income from a game of 2 million, we've got core expenditure, which is all UK costs of 1 million. We've got some non-core expenditure, i.e. that falls outside what is eligible for video game expenditure credit. In this case, we have a taxable profit of 600, and the corporation tax rate on that is 150,000. The government wants to give you some money and support. As I said, it's gross income. In this case, it's going to be 80% of your core costs. That's 80% of the million, which is 800,000. The VGEC gross income up 34% to 272. And as I said, you then deduct the corporation tax rate, the main rate of 25%, leaves you with VGEC income of 204. So you've got a corporation tax liability of 150, and the government wants to give you back 204,000. So overall, they typically net those off, and you'll get 54,000 pounds back from the government, which is a very generous scheme. So that's just the VGEC rates that I'm talking about there. Now, I'm now going to talk about something about why VGEC cash, so this is where you're operating at a loss or break even, why it can get delayed. Now, each qualifying game is reported as a separate trade. That rule still exists from the VGTR. And only until a game is completed, you can't offset any losses from that game against other trades. So if you've got a game that's not completed at the year end, you will have something called trapped losses. You cannot offset it against other trade until that game is complete. And nobody likes to see trapped losses. Now, the actual amount of trapped losses, which is the next slide, is pretty much the losses of the VGEC trade at the corporation tax rate. So that's usually 19% if you're a small company, or 25%. So that's the actual amount of losses that get trapped. Now, If you've got a number of trades and your main trade, for example, and you've got a VGEC trade for a particular game, and that is loss making, if losses get trapped, you can in actual fact end up paying more corporation tax early and only be able to recover that at a much later date when the game is completed. Now, I will just give an example of that in numbers. So this game we're talking about here with a £1 million video game core cost expenditure would not complete at year end. So before we do the VGEC claim, it's all one trade. So if you, for example, not claiming VGEC, this is what the position would look like. In this case, in this example, your company's income is 10.5 million, your expenditure is 10 billion. You've got a nice profit there of £500,000, corporation tax at 25%, so it's 125,000. Okay, fine. But however, because you're claiming VGEC, you have to separate out the trades, by in this case, a separate trade. And I'll go through that slide with you. So this is after, well, whilst you make it, well, when you're making the VGEC claim. So your non-VGEC trade, your income remains at 10.5, but you're going to have to split out your core costs and your non-core costs. So we said in total your cost was 10 million, but 950,000 relates to the VGEC trade, relates to that game which you have to now report separately from the purpose of your corporation tax return and of course your tax computations. So, and also we have 50,000 of non-core expenditure. In total, it's so we're taking £1 million worth of expenditure out and we're putting that across to the VGEC trade. So what that does, that increases your non-VGEC trade significantly by the 1 million. So suddenly you've got taxable profit loss of 1.5 million. You've got to pay corporation tax on that at 25%, it gives you 375. And if you can see just here, in terms of this calculation, the 950, yes, that's £1 million worth of loss there because you've got no income, because the game's not complete, it's not been released. The corporation tax on that million would have been at 250, so therefore you're losing 250,000 of corporation tax, and therefore that corporation tax there is trapped. Yes, they'll give you this wonderful VGEC credit. In this case, 80% of the core costs. That's 80% of the 950. Let me just get my pen if I can on that. So yeah, just here. Sorry, that's completely wrong. There we go. The 950,000. So you'll get, that's the 80%, the 760. You've got your gross income, take off your tax, your net income. So you're actually going to get 193,800 back there. However, you've got to pay across 375 because your 250 just here is trapped until the game is completed. So in this situation here, you were going to pay £125,000 corporation tax, but after splitting it out, you've now got to pay 181,200. Which is the 375,193. So we do not like trap losses. So I suppose that raises the question, how do we avoid trap losses? And yes, this wonderful special purpose vehicle, which is in essence a separate legal entity, this is where it comes into play. And I'll just quickly go through what an SPV is in terms of for a video game development company. So it's in essence, the video game development company is a company that actually produces the game. So it's got to be responsible for the lead design, production and testing, oversee the planning and the key decisions, and also contracts and pay for all related rights. And also, wherever possible, make sure that you're paying for your third parties as much as possible as you can through the SPV. I appreciate that's not always possible, particularly if you've got a group structure and you've got administration and management recharges going on. But when there's opportunity, I would strongly recommend that you try and pay some third parties direct. It's an area which HM Revenue and Customs are starting to dig into a little bit. We have this wonderful thing called the additional information form. And within that, they are asking questions related to how much intercompany connected party recharges are. So they're starting to ensure and identify that the SPV, i.e. the video game development company, is set up for the correct purpose, and it has to be responsible for those areas that I've just outlined here. Okay. So SPV, in terms of its basics, it is a separate legal entity, just given a very fancy name, as a special purpose vehicle, but it relates to a particular project or activity, or could be an asset. Another example, there where people buy property and they put it into its own special purpose vehicle. It isolates risks and operations from the parent organisation, so that's one of the benefits. It gives financial clarity because you're having to transfer costs in, and also you're looking at income being within the SPV, governance clarity. But what it does also is provides you with the controls and levers to avoid this horrible thing called trapped losses for incomplete productions at production as in games at the year end. And that is a very key area. So you're thinking, right, okay, we'll set up a special purpose vehicle. I'm going to put a game through that, one of my key titles that I'm currently developing. And you want to think to yourself, how can I make that break even? And I'll just go through that. So just before that, the typical structures that we get with SPVs, and there are variations on this. One size does not fit all, as they say. So you'll have a parent simply has just one game. You could have just one game production company. If you've got many small titles that you're producing, that is fine. It's a structure that we do operate with a number of our clients. Our larger clients prefer to have a SPV for each of their games. So you see on the right-hand side there, you've got game A, game B, C, C, etc. Normally for larger budgets in terms of game production, and then you can have multiple parents and co-ventures setting up with an SPV, and therefore the shareholding is split between the co-ventures based on the shareholders' agreement. So I have different structures that you can put in place. Now, what is key in setting up an SPV in order to get to a break-even position as well, and making sure that you have all the legal framework and agreements in place, there's 4 key documents that are absolute must. The first one is a working capital loan agreement. So this enables the SPV to have funding available to be able to pay the third parties. And that's an intercompany working capital loan agreement, can come from the parent, for example. It's not a huge amount, but it does allow them to start trading, and as I said, provides an audit trail that you've got money going out to the bank directly to some of the third parties. A key document, which I'll go on into in a little bit more detail, is a production agreement. We actually call that a production and commission agreement. This is the backbone of the arrangement that identifies the SPV. It's a video development production company, and it also talks about the commissioning that the parent or another entity within the group is commissioning the SPV to undertake the game development work. One area which I would always recommend is transfer pricing policy, just to make sure that is done at arm's length pricing. So it's always, particularly if you've got overseas entities that provide some of the services as well, everything needs to be done at arm's length. And also beneath that is also claiming the cost at economic value, not necessarily the transfer pricing value, particularly for an intercompany transactions. And also, I would recommend that you have a management, administration and services agreement, which could be from the parent, providing head office type services, HR, finance, senior management, etc., and also some other services. But yeah, they're the 4 key legal agreements to have in place. And I believe now I'm going to touch on the production agreement. So the typical production agreement is the mechanism behind this allows the SPV to be break even. So in essence, the parent will commission the video games development company to produce that game. and therefore it's a commissioning fee. And that fee equals the budgeted costs of the game development, however, that is then adjusted to actuals. So the SPV is invoicing the parent company a commissioning fee for the cost that it's actually incurring. So its income and its costs are equalized out, therefore it becomes break even. We suggest, because the SPV is receiving income from a commission agreement, the parent can retain or should retain all the income. So that's how we would operate that. So the parent retains all the income from the game. However, the commissioning from the SPV's commissioning fee, which does equal its costs. The video game development company needs to negotiate the contracts. That's an area that HM Revenue and Customs are starting to look at. Beforehand, they were simply thinking, oh, VGDC is just a pass-through, it's absolutely fine, we can put our claim through there, leave all the costs in, could be a subsidiary, it could be the parent, we're doing some journal entries to record that. That is now considered to be high risk, and I would avoid. So you need to have the VGDC negotiating contracts with any third-party suppliers, developers, designers, etc., wherever possible. The video game development company bears the development and the testing costs for that game. It needs to have control, so control in terms of its operation and decision making. And as I said before, the connected party costs, although they are recharged at arm's length pricing, they need to be claimed at economic value. Now, economic value, in simple terms, is the cost of that particular service or that staff member added on the cost of overheads that you can apportion to additional costs for that individual, that staff member, or that service. So it's not always necessarily the arm's length. So you can't say, I'm putting my development team through, I pay them roughly 80% of what's considered arm's length. I'm going to suddenly put in an extra 20% on the arm's length price. And they're like, yeah, great. No. They are starting to do what we call a look through HM Revenue and Customs, and they want evidence that you have calculated and you are claiming at economic value. That's an important step change that we've seen over the last 12 months from HM Revenue and Customs, and also I think it's an output from the additional information form and the data they are collecting. Okay, so we're going to go through a typical structure and funds flow here. We have one video game development company, and it's got the parent. So to start with, the parent provides a working capital loan to the video game development company, the SPV, just so it can start contracting with contractors, suppliers, maybe staff, etc. And once again, bearing in mind it's got to be the video game development company, it's got to be the decision maker in this. The parent management, they invoice services are charged to the SPV. So you have that intercompany management administration service agreement to support those charges. Once again, at arm's length, although you can only claim for the economic costs. So number three, and this is where the video game development company is paying directly for contractors, suppliers, and wherever possible, staff. I appreciate some of the staff may belong to the parent, and that would be covered under the agreement. But if anybody is required to work on this particular game, it would be great for them to be invoicing directly. Oh, sorry, apologies for that. Invoicing directly to the video game development company. The commissioning fee, so the video game development company is picking up all the costs. It is recharging a commissioning fee, initially at the budget, but it is adjusted for actual costs. It charges that commission fee back to the parent. And then when HM Revenue and Customs pay your video game expenditure credit, your VGEC, that money comes into the video game development company. The video game development company that cash, it can go and pay the parent back its intercompany loan, of course, to support it. The same, and any gross sales or revenue that is received, if necessary, if it goes to the video games development, it goes to the parent. I do want it to go to the parent. It does depend on your corporate structure, and then you can any post-tax profits, i.e., the income from the VGEC, can be passed back through a dividend back to the parent company. So there, in this situation, you're ensuring that you have no trap losses, because what you're having in this situation is the video game development company is at break even, and the parent is therefore able to receive the costs, but however those costs are tax deductible from the parent's perspective, i.e. the commissioning costs, and therefore you avoid this horrible thing for of trap losses. So in essence, you're getting your funds from VGEC as and when you develop the game, and you receive those in year one, rather than having trap losses because you've got an incomplete game. Now, if I'm not already confused you enough, because I know this might sound a little bit complicated to some people, we do help and we do provide services from start to finish, and I'll just run through how Myriad can support. So we have specialists that focus on getting the company structure right. So that's the first part of anything. How many SPVs do I need? What happens if I've got co-ventures? How do I handle that? Should the SPVs be a subsidiary of a subsidiary, blah, 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 etc., etc. That's my specialist area. I've been doing it for far too long, and also to ensure that obviously we remain compliant. So we also provide, we have the agreements, so any what I call internal agreements. So this is between agreements between the entity themselves, and we can handle external, but typically focus on the internal. So yes, we can do production commission agreements. We have the templates and the knowledge to put those in place based on the specific structure. We also have a team that does transfer pricing and economic cost filing documentation. We do intercompany management, administration service agreements, so we can handle all those legal agreements on your behalf through our specialist team. And then we have people like Chris, who's one of my colleagues that will come on very soon, answer a few questions. He's our BFI guru, but he also does cost analysis, apportionments, trade games, schedules, etc., etc. We have a specialist creative tax team. So for VGEC claims, we can do company tax return. Computations get pretty difficult. You have to split them by trade if you've got multiple games within one entity, which some of the smaller studios prefer to do, run an SPV as a development company, and put each of the games through just the one SPV, and each one's break even. We have to split that out by trade. We also work very closely with the HM Revenue Customs creative units in Manchester, and we are so we can represent you as you know, on behalf of representing you to HM Revenue Customs. We get involved in something called discovery assessments. That's if you're going through and making previous claims, and therefore have to rediscover what's a corporation tax liable because of you making historic video VGEC claims, which were because doing it on a cumulative basis, for example. And we also get involved in supporting if any kind of inquiries or questions that are handled by HM Revenue Customs, and that is particularly in terms of compliance checks. We do get asked for not originally our clients, but there's some confusion or mistake made on the tax computations, so we might be drafted into work on that particular area, although they're not an original client. And in addition to all that, we can do statutory accounts, we can do the management accounts, and we can do the bookkeeping, and we can do things like VAT group registration, which is important with SPV structures. So we can handle pretty much every aspect from start to finish. You can pick and choose the areas that you would like our support with. But yeah, so we are here to help and support. And I think that's about it. I've done a huge amount of talking. So I would like to bring in Chris and Kale. So Chris, Chris is the prolific gamer, spends far too many hours at the weekend, Chris, I believe.
No comment.
And Kale's, he's the guy that set up the webinar for us, and he's going to be monitoring the questions. He's going to shoot off with them. So that's, yeah. Any more questions, as I said, please put them up in the Q&A. So over to you, Kale.
Yeah, so we did have a couple of questions coming through to us beforehand. So I'll just kick that off, and then, as Barry said, there is a Q&A at the top of your screen. So if you want to submit any, you can submit them there. The first one we have here is: can an SPV be set up with multiple owners, and how is the VGEC shared between the owners?
I can answer that one, absolutely. First part of that question is yes, it can. So multiple owners can have an SPV, and then so that's absolutely possible. So I think I shared that as a typical structure where you've got multiple ventures. And then in terms of how it is split, there are a number of ways of doing that. But in essence, it could be done at the shareholding level if necessary, about who owns how much, and you share it through that way. That's one possibility. And the other way of doing it is that you can do it through even one of the co-ventures, if they wanted to take the whole lot. I mean, it's shareholders agreement. So it's really depending on I suppose the input that's required there from the various parties and how they feel it needs to be shared. But it can be done absolutely fine. And we have that with multiple clients that have different setups. Could be 50-50, 70-30, and they sometimes want the actual credit itself split in different ways. So it is possible. And those share classes, etc., you can change all those. Yeah. So yeah, basically, however you want it, as long as you get the corporate structure correct and the shareholders agreement correct, and the share classes correct as well.
Okay. And this is one that would have come under our fundamentals, but what costs come under VGEC?
Yeah, sure. I'll take that one. So in terms of what you can actually claim from a cost point of view, we're looking at specifically the design, development, and testing phase. So conceptual development isn't allowable. So all the points up to where you decide you're actually going to make the game. So just doing feasibility, etc., we can't claim for those costs because the game hasn't moved in production. But as soon as you green light the game, up until the point where you complete, so it's in its first form, ready to the general public, then pretty much most of the production costs are going to be eligible. And that's going to include things like staff costs, so your designers, programmers, testers, artists, all of that you'll be able to claim for. If you're working with subcontractors that are delivering those elements, you can claim for those. Definitely apportionment of overheads, which is what people forget about. So if you're running a studio, your rent, rates, etc., those can be apportioned based on staff time on the qualifying project as well. And any rights that you're also paying for. So if you're paying for rights for an IP that you need to do to actually use that, you can claim those costs back again as well. What you can't claim for are things like commercialization and maintenance. So things like bug fixing once it's launched, that's not included. But if you develop additional levels after post-launch, then you can also claim those under the same certificate, so long as the fundamental of the game and how you receive that certificate didn't change. So it's quite an all-encompassing incentive.
Perfect. Thanks, Chris. And then the final one we have here is: if I create an SPV after incurring production costs, can I move those costs to the SPV to gain my full relief?
The short answer is no. You've got to remember the SPV from the date it was incorporated is really when you should actually be putting costs, or the SPV can incur costs. There is something called pre-incorporation expenses and costs that you can put through that you obviously pick up. But it's normally limited in, I said, got to be pre-incorporation costs that you pick up and you transfer those through. But generally speaking, the answer is no. Get your SPV set up ASAP and absolutely ensure that you have that production and commissioning agreement put in place. That's the most important document there. Because as I think I've said, Hayton Redmond Customs are getting very, very starting to make some noises. I think it's in terms of making sure that a video games development company, i.e. the SPV, is just not a pass-through of costs, i.e. It wants to see bank transactions. It wants to see invoices being raised. The days, in my opinion, days of journal entries, etc., to put the costs, i.e., and it's literally a paper exercise internally, they're gone, and it is a very high risk strategy. But yeah, so in terms of dates, it's already started the game, for example. No, I think, Chris, it's fair to say, Chris can answer this one, but if it's before it's greenlit, then that's fine. You can put all those experimental type stuff through and then set up the SPV. It's not too late for that.
No, I would agree with that, Barry, because you're not actually into production at that stage, and the incentive is about the production.
Correct. So yeah, so I would say if you're at that stage, the early stage, then yeah, get that SPV set up ASAP. I mean, a company formation, we're talking about going to company's house. It's not that expensive. The price has just gone up recently. I don't know, it's £50 or £100 now, but it's only just recently gone up. But it's still relatively cheap. Get it set up. Leave it there dormant. Yeah, I mean, it's dormant accounts. You know, cost peanuts to file. That's my take on it anyway.
Perfect. And then we did have one come on now through Gemma. Gemma says, or asks rather, a big change from VGCR to VGEC is the requirement for services to be, in quotes, used and consumed in the UK. If a freelancer is based in another country but contracted by the SPV, are the services provided always deemed to be, in quotes, used and consumed in the UK?
I'll take that one. It depends what the freelancer is doing. So for the purposes of used and consumed in the UK, if that person is committing the work, so say they're a programmer on the game, then it's because of the way video game development works, HMRC will consider that wasn't consumed in the UK because they're committing their code to the project outside of the UK. So it's based on where that person is physically working from. Where that rule plays in your favor, though, is for things like software costs. So if you're using Unity or one of the other big platforms that aren't UK-owned software, you can claim those costs because you're using those within the UK. I hope that clears that up for Gemma.
Perfect, thanks. We do have a couple more here. We've got Josh Taylor Rose, who has asked, in relation to the transfer pricing agreements, do HMRC permit intra-group recharges at cost plus when talking about economic value? And are there any benefits charging cost plus over just cost to the SPV?
Okay, there's two definitions here. First of all, we're talking about recharging at arm's length prices. So that's typically what you expect to pay that individual, that person, for providing those services. That should really be what's transferred at. Now, if the cost plus mechanism that's being used relates to or is similar to the arm's length, then that's absolutely fine. But you have to have documentation that says for this type of designer, for example, working at this level, Unity, whatever, these are what we consider to be the market rates. Have that documentation in hand. That's the arm's length. In terms of the cost plus, now I'm talking about economic value, which is the bit. So economic value is a value that you claim at in terms of for video games expenditure credit. If you're saying that it is the cost of that individual and the plus is the overheads related to that individual, i.e. you might have some head office costs in terms of electricity, in terms of space, in terms of insurance, you name it. If that calculation's done and you can justify that plus, so you're saying I'm charging this individual at their gross salary, plus the company's national insurance, plus overhead recovery, which is got calculations, then you can charge that figure across. So you claim, I call it economic value. However, for the purposes, and this is normally because of the different tax jurisdictions and different rates, particularly with a significant difference. Take the UK and Ireland as an example. If you've got Irish people working on the project, and therefore you want to transfer those across from Ireland to the UK. Now, of course, you can't claim the costs for Ireland because obviously it's not UK costs. However, they are costs for the development purposes. You have to there provide the arm's length pricing, the OECD standards, rules that come in place, because you've got Ireland at 12.5%, and you've pretty much got the UK at double that at 25. So that's really where that comes into play for cross-tax jurisdictions for arm's length pricing. But it's something which every company should be doing anyway, in my opinion, to make sure that they're operating at arm's length pricing, also making a profit. But economic cost is what you claim. And there's a key difference between economic cost and arm's length pricing. One is market driven. There is what your actual costs are plus a overhead recovery. But you have to have the workers to justify that. I hope that answers the question.
Thanks, Barry. And then we do have one here from Susan. I think this is in relation to the example you went through earlier. But Susan asks, so you would expect to see 34% credit in quotes, other income in the P&L, and then the corporation tax deducted in the usual tax expenditure line, question mark.
Yes, that's correct. Yeah, so the gross income will be reflected in other income, and that is subject to corporation tax, correct, at 25%. Absolutely correct.
Fantastic. Okay, well, we don't have any more questions that have come through live on the call. So that's it from the Q&A from me, guys.
Perfect. And Carol, I think we're going to obviously send these out, aren't we, to everybody? And I'll get in touch with those that have asked any questions, just to make sure that they're okay with the answers we've given, or anything further that they want to ask on. You've got my email address on there, so anything to do with the corporate structure or tax side, please feel free to reach out on my email. And anything to do with creative industry, so anything to do with BFI and also the costing area, that's our in-house guru, Chris. He really enjoys playing games at the weekend. Yeah, so I think, as I said, there is this fundamentals webinar that we had. So if you want to get back to some of the basics, that's on YouTube. And at some point we will make this public as well, but we'll also send it out to everybody. I'd like to thank you for your time. As I said, reach out to us if you have any questions. We're here to help and support. And I suppose all I have to say now, it's a goodbye from me.
Goodbye from me.
Okay.
Goodbye from me. Thank you very much, everyone.
I love that bit. Cheers, guys. Thank you. Cheers.
Cheers. Bye.